Okay, so good evening, everybody. You are all welcome to tonight's class. So tonight's class, we are going to be looking at the last time we met, we've done a lot of things. We've looked at fixed asset. We looked at how to get our trial balance from posting and also how to get our trial balance from our bank statement. So I gave us something like this where we have like bank statement information. Then we are going to have the months, the value date, the direction, the debit, the credit, then the source, what bank we're getting from, the own narration. So this your narration now is what enables you to link your bank statement narration to your trial balance. So I gave us a sample trial balance, not this one. I think I gave us something. Okay, it's not, but yeah, I think it's this format as well. So we put the Excel, we use an Excel formula to actually get the what's needed to be posted. So we use that the last time. So I think, let me just go and check for, instead of me to look at this one, let me go and check for, okay, let me open this account. Manufacturing account, let me open this, let me see. Yeah, so yes. Is it? I think so. Yeah, so this is what we used for the last lecture that we had. So we were able to look at the inventory management. We looked at items that we needed to create when we start going to our Zoho books. And I told us that we have uh, in a manufacturing environment. I told us that we could actually have items to create, right? So now if you are creating material, that is for a manufacturing environment. When you're creating material, you make sure that that material has quantity, but it should have purchase price, but it shouldn't have selling price. Okay, because each of this material is what you're going to use to create your finished goods. So what we call finished goods in software is what we call composite items. So from your material, you can go ahead to now create your own finished goods. So you could have items, create items for materials. You could also create items for finished goods. And most of these finished goods that we're going to create on the software, they are finished goods that we purchased. So finished good that we purchase, right? So it's going to have like the selling price, it's going to have quantity, it's also going to have like also going to have purchase price, okay? Because we are going to buy it from a vendor, then how much you want to sell it, what margin you want to have on it, okay? So this is the finished good that we purchase. But if we are talking about finished goods that we want to manufacture, we are going to manufacture it from our raw materials, right? So we have different raw materials together to create bread, for instance, to create to create cake. We call them assembly. We create an assembly of things, okay? We create an assembly of things. This assembly of things is what we convert to finished goods. So then we also have kits. We can also create kits. Kit is a single, so it's different combination of different items that is used for one single product. Okay, so we can also create kit. I also told us about our stock, the type of stocks that we have. I think that we have what we call accounting stock. We also have what we call physical stock. And I told us when accounting stock is created. For instance, when you raise a purchase order, you want to buy something from a vendor, you send a purchase order, right? At the point when you actually receive that goods that you want to purchase, when you receive the goods will be received in your physical store. But when you now settle the bill, when you pay the vendor, that is when your accounting stock will be created. Also for your sales order, when you issue a sales order, right, at the point of shipping that goods to the customer, the physical stock will reduce. Then at the point of creating an invoice, your accounting stock will also reduce. Okay, so that is for that. Then we also look at a lot of things. We could look at purchase order. We could create purchase order. We confirm it. Then we receive the goods in our warehouse. Then we pay the vendor. Then for sales order, we confirm that it's okay. Then we ship it to the customer. Then we raise an invoice or something like that. So then we have, I talked about drop shipment the other day. I also talk about back order. Just like a quick recap, okay? But this is not what we want to look at today. We'll still go to Zoho Books to actually get a good hand of what we have. But today I want to talk about, I want to talk about, there's something we did the other day, the trial balance that we did. Okay, not this one. Yeah, so this is the one we did. So the other day, we're able to actually create, okay, from here, we're able to get this trial balance. From this trial balance, we now generated our manufacturing account. From our manufacturing account, we went further to now go to our trading account and all that. But that's not what we want to look at. We did want to look at this, our trial balance. Once you know your trial balance, you can either get it from your daily posting, just like the way we were able to get this, our trial balance from our posting. You can also get your trial balance from your daily postings. However, if you don't want to use your postings, let's assume the company does not have records, right? You can simply go on to now ask for their bank statement. With their bank statement, you can also generate record for the company. So an example is this one. When you check this one now, you will discover that here we just pick the bank statement of a company. We now narrated it. We did our own analysis of it. And from there, we now also do analysis of what these transactions are. So the first one we say is auditor's fee that we paid. The other one is bank charges. All the figures that are small, we call them bank charges. At the end of the day, since you have linked your trial balance to this stuff, your trial balance automatically will generate on its own because you have linked your trial balance to that place. Okay, but this is not the format of the trial balance we want to use. I say we're going to use this type of trial balance. So once you've been able to populate your trial balance, right, the next thing you want to do is that we want to now link it to this account I'm going to share with us. So I call it a sample company, audited company, okay? A sample audited company. So what do you need to look at? So this account that I'm showing us now is like the account that auditors make use of. It's going to have front page like a normal account. So you can edit the front page to whatever taste you want to do. The content is already also here. You can also adjust it in case of a tasting. You're going to have your director's report. You can always edit it. Auditor's report is also here. You can always edit it. Then you now have the policy of the organization. I told us that to get this policy for this organization, we need to go to IAS. I think I mentioned the other day. Is it IAS.com or let me see. IAS. Let's check. IAS. IAS. IAS.com. I doubt. But let me see. IAS. Nah. Yeah, IAS Plus. So go to iasplus.com. So this is where you go to. Once you want to get policies for your organization, simply go to iasplus.com. That is the site that was created by. So from this site, you can always get different policies that you want to use for the company that you are trying to do account for. Okay, so this site is very on standard. You can select any section. You're going to see different standards that you can expand to know what it contains. Okay, from there you can copy whatever you want to copy and come over here. So this is a site that contains all the standard, anything you need on IAS, on IFRS and everything. You can always get it from iasplus.com. So once you've been able to get it, just come over here, okay, to your account. And from there, you come and put all those policies according to the way it is in the standard IFRS, International Financial Reporting Standard. So you just get it like this. So now these are the policy page, okay, which you can always get the policy page, read them. If any of them is outdated, you can always redo them. There is another policy, right? Policy page 9/10. So this policy now, okay, so it's talking about impairment. Most of us know what impairment is, right? And we know the standard that talks about impairment. We have IAS 36 that talks about impairment, but this kind of impairment that we're talking about is in relation to IFRS 9. Okay, it's in relation to IFRS 9. So you can also read IFRS 9, know what IFRS 9 is talking about, so that you can, when you are looking at this policy over here, you know what needs to be adjusted and what needs to be done. But most of these things are linked to each of the accounts. So if you can do your account very well, each of these things will populate on their own. So what is the area that we need to edit? Some areas does not need to be edited. Some areas are just going to populate on their own. The only thing you can edit is either the name, the title, then what year are we looking at? What year are you looking at? Then the profit and loss, what year are we looking at and all that. For all the figures, they are going to populate on their own. So even this heading, you also change this heading, okay, based on the year you are currently, you also touch it. Then the next thing you want to do is you want to now come to, this is changes in equity, cash flow, note 1, note 2, note 3, note 4. So what we are going to now directly is we're going to our extended trial balance. If you come over here, we are going to see extended trial balance. So over here we have 2019 extended trial balance. This 2019 extended trial balance is the combination of both the extended trial balance from January to June, January, February, March, April, May, June, from January to June, and then from July to December. So we are keeping the account like biannual. The first extended trial balance is going to be from the 1st of January 2019 to 30th June 2019. All you need to do is that change the year. What year are you? Change the year. Then another thing is that you now see that the format of what we have here is exactly what your trial balance is that I showed us. Your trial balance now is going to start from your share capital. So what do you need to do? Just check anywhere. Let's look at those our trial balance now. Is it this one? Yeah, I think it's this. Okay, this one actually. Okay, not this one. Check the other one. There's one that I linked. Okay, yeah. So this is it. So what we just is that just come over here. You know, this is what we have over there. So you just come to that, your extended trial balance. Yeah, this is it. So yeah, the first thing you're going to look at is this value, which is your share capital, right? You just simply say equal to, you say equal to, right? You now come to this one. Come to this one. Yeah, you can come to this one. In fact, you can even put the formula. That formula that you did, you can also even do it in this place. So let's just come over here. Is it this one? No. Yeah, so equal to, we now select this one. Yeah, I think is this, no, it's not this one. So equal to, you now select this one. You click it. So automatically is updating on its own. So you see that, yeah, we have something here. So that's how you're going to do for each of them. When you get to your retained earning, you also do the same. You come here, you say equal to, you come to where you have your trial balance that you are keeping separately. You have your trial balance here. Where is your retain earning? Over here, you come and click here. You just make sure that everything is linked. Then the next one, you just quickly link everything. And once you link everything, automatically everything you have linked is going to be. I'm going to show those other reports. So what are the things that we can actually do after we've gotten all this, right? Let me expand what you have here. Let me expand all these things here. Okay, so you look at it now. These are different banks, different banks. So here, now, we have gotten our trial balance. So let's assume there are other things that we also have in different banks that also relates to this our capital, right? So let's assume there are certain or certain adjustment that we've done to our share capital. Maybe there's a debit to it, there is a this, there's a that. So what you're going to do is that you're going to add everything on the credit side. So this plus this plus this. So you can say this minus this plus this minus this plus this minus this. So that at the end of the day, we want to have, so at the end of the day, we want to have the, once we are done with that, right, we now discover that I told us the other day that everything that you have at this first place, everything that you have over here that I colored green relates to your balance sheet. Okay, then everything that I colored to be yellow, all of them relates to your profit and loss account. Okay, so what you need to do is that once you have finalized with putting all those figures, any adjustment that you have is what you are going to use all these ones for. Any adjustment, Heritage Bank, Heritage Bank dollar account, different banks that you are keeping. Let me check for this. Okay, GT operations, there any adjustment you have in each of this bank, you're going to do them in this place. So that at the end of the day, if you check this formula here, you will discover that it's actually saying C5 minus D5, which is like saying that your C5, this is your C5, Abby. C5 minus D5 plus, so all the credit side are going to be added. So this now, C minus D, which is debit, this minus this, plus this, 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 minus this, right? So, and you're going to have the answer here. So let me just do something like this. Then let me check. Where is it capturing to? Oh, sorry. I'm coming. Yeah, so the last two here will not be touched, okay? So we just want to populate into these last two, right? So the last two will not be touched. So we are able to, so this is what we call with the revised balance. This is the revised balance. I mean, what is the right word for it? So I want to like select all these things again and make sure I am getting it right. Okay, so this is good. So that is how we're able to get all those things. So we're going to say this plus this. So we are trying to get a one single balance at the end of the day. So it means that we actually started from our trial balance, right? But there could be other adjustment, like year-end adjustment. There could be some year-end adjustment that happen. Probably there's maybe like there is a loss that will actually affect the share capital. So when there's a debit here, okay, so you need to adjust for it so that at the end of the day, you want to have a revised balance at the end of the day. They also don't forget that all the items that are green, all these items that are green, they actually represent items that is in the balance sheet. While all the items that are yellow, represent items in profit and loss account. So when we go back to the top again, so we are trying to look at how to make use of this thing I'm showing us. So once you understand this, then let's now go straight to other things that we need to look at. So let's go. Now we have gotten where the revised balance is. This is where our revised balance is. Now, an extension of this now, immediately after we've gotten this, we are going to have our account. The first account is our profit and loss account. The second account is our financial position, which is your financial position. So what do we want to do? We already know that all the items at the top that are green, so those items represent the balance sheet. So it means that automatically we are posting all these things into our financial position. So what are we going to have? The first thing we're going to have is we're going to have normally the way our balance sheet. So we know what our balance sheet is. Our balance sheet is to explain that accounting equation that says that the total asset that a company has is made up of the equity and the liabilities. So it means that here in our financial position, we are going to have all the assets. We're going to have our current asset, we're going to have our fixed asset, then we are going to have our equity, we're going to have our current liabilities, we're also going to have our non-current liabilities. So that's what we're going to have. So when you now come over to this side, so most of those transactions that we have over here, like this is share capital. So it's also going to be, the classification is going to be here. So this is our share capital, right? Then the next one, retained earning, which is also going to be our revenue reserve. Then we have director's account, which is represented by other payables. Director's account, other payables. Then we also have some other items over here, like that. So all these are the deferred tax liability. They are all other payables, current tax, other payables. Then after that, we now come to this auditor's fee is also other payable. Then when we come to professional indemnity, insurance payable, these are provisions. We are creating provisions for things, expenses that we've not paid yet, right? Remember when you are, can you unmute your mic? Does anybody know how to create provision? Hello? Can anybody hear me? Do we know how to create provisions? Does anybody know how to create provisions? If you can hear me, let me know. Can you?
Good evening, sir.
Yeah, good evening, sir.
So I think it depends on the provision, the kind of provision.
Okay.
For instance, yes. For instance, if the provision is for like salary, for instance,
Okay.
is there will be two accounts involved.
Okay.
You have salary payable,
Okay.
salary payable account. They also have salary expenses.
Okay.
So in your provision now, you debit salary expenses and credit salary payable. So when you
Okay.
now eventually pay it, then the portion will now be between the salary payable and the bank, which the payment is made.
Okay. Yeah. Yeah.
Yes, I don't know if
Yeah.
that is okay.
Yeah. You are correct. You are correct. So, does anybody also have any other idea? So let me ask you, sir, why do we actually create this provision?
Okay, so I think for some reason, not one reason.
Okay.
Now, let me use the same salary as an example. Sometimes at the end of the month, maybe today is the end of the month, salary is not yet paid for, and
Okay.
it's an expenses that we cannot dodge. Is a must, is a compulsory expenses that we must incur. A month has ended. So
Okay.
for us not to carry over the expenses over, we need to recognize, just like we need to recognize the expenses of this month in this same month. So we create provision for it. and carry over the liability over to the next month and pay it. I don't know if this the simplest question also is okay.
Yeah, so you actually tried. So, most times they say that accounts, they are periodical. Most times you discover that they are what we call temporary accounts, and they are also what we call the permanent account. There are some things that are temporary, while there are certain things that are permanent. For instance, you look at your assets now. Those are primary accounts. Like those assets, they are always going to be showing them in your balance sheet. Like the movement of those items are going to be in your balance sheet. Liabilities, assets, and all those stuff. But there are some items that are temporary. For instance, your income is temporary, your cost of sales, all those are temporary that will not go beyond one accounting period. So you discover that since accounts or profit and loss accounts are prepared on a periodical basis, right? So we say that okay, an accounting year end, you must make sure that every expenses that you incur for that period, for that accounting period, right? Make sure that you actually make provisions for them so that at the end of the day, the profit that you're going to show, right, will be the actual profit that you should have when you have catered for all the expenses that actually happen for that period. So the basic thing is that they want to make sure that, okay, they don't want to overstate profit because, for instance, if we are supposed to pay salaries to the tune of 10 million, right? And then we didn't pay it, then we are not declaring a profit of 10 million. It doesn't make sense because that profit we are declaring, we are, even though we have not paid the salary, but we have already incurred it. Sorry, did I say incur? Expenses are incurred, yes. So, but we have already incurred it, right? They've already carried out an activity for us. They've carried out a service for us. We discovered that if you decide to leave that 10 million as your profit, it will you are going to pay tax on it. So why not cater for all expenses that you need to cater for? Even if those salaries you've said that okay, because these people they've not finished their job, they are not going to pay them until they finalize, or maybe they say okay, until they do certain things, they carry out certain tasks, you're not going to pay them. But you know that already you are already owing them that money. So it's better to now create a provisions for that money so that the profit you're going to be declaring will be the true profit that actually should be declared for that period. So that it's not like you are actually showing a profit that is not actually um, correct. Okay, so you make sure that you cater for all expenses that have been incurred that you don't want to carry over to another accounting period. They have been incurred in this accounting period. They should be catered for this accounting period, irrespective of the fact that you've not actually paid for them. So how do we create provision? What we're trying to do is that we're trying to set it aside those money that okay, this money is for the salary. Let's not touch it, even though you have not paid those people. So what do? You debit your admin salaries account, right? Which is the one that is in your profit and loss. Then you now credit your salary payable account. So one is going to go to your balance sheet because it's only in balance sheet that you have items that are not going to to finish in one accounting period. So all liabilities in your balance sheet, right? In your statement of financial position, that statement of financial position shows the accounting equation that says all assets that a company owns is generated by saying what is the contribution of the equity holders and what is the loan that they borrowed. So it's going to show your current liability. It's also going to show your long-term liability. Okay, sir, I can hear you, sir. Mr. Olu.
Yeah, thank you very much. Yeah, I've understood what you said and what provision means. Um, is amortization the same thing too? Is it the same thing as provision too, sir?
Not really. So amortization is just like depreciation, right? So amortization is like depreciation. So what amortization is like, you have certain, Now, the reason why we amortize those things, I told us that assets and liabilities, sorry, assets and expenses, there's a thin line between them. So assets, they are also expenses, but they will not allow you to take that, the total of that money that you incurred on that asset. They won't allow you to take it in one accounting period. Why? Because it's okay, this asset is going to last you for more than one accounting period. Why are you taking all of them in one accounting period? So amortization, or when we talk about depreciation, is like we are spreading expenses that we say, okay, because these expenses is not going to be consumed in one accounting period, right? Like those assets, you cannot consume them in one accounting period. So we want to spread them to all the years in which that asset is going to be useful for you. So that is what depreciation is. Depreciation is like an expense. You've incurred money on that. So if they should allow everybody to buy assets, okay, and not capitalize it, you discover that people can just say, okay, I have a profit of 20 million. You just take all those profits because they don't want to pay tax to government. You just take all those profits, you just go and buy assets. No, it's an expense. They allow it. It's an expense, but they will not take that. Okay, well, even though we allow this expense for you, we cannot take it in one accounting period. We spread it over the period that the asset is going to be in use in your organization. So it is not provision, sir. This is an expense that you've incurred beforehand. You are only catering for it little by little. It's like you are taking those, you are now like putting those expenses in your account little by little instead of you taking it once and for all. I don't know if you understand that, sir.
Yeah, I understand, sir. It's clear now.
Okay. Okay. Yeah, thank you, sir. So that I believe that I've been able to explain what provisions are. So you discover that most times provisions are going to be used for payables, things that you need to pay, right? So look at it like you talk about here, we're talking about salaries payable. Okay, you are raising a provisions for it because this salary was incurred in this accounting period. So we don't want to over declare profit. We want to declare the right amount of profit. So it means that we are going to create an expense for it in our profit and loss account. Then we now create a liability for it in our balance sheet. So this is what our provisions is talking about. So all these are provisions. So we also have these, which is also a provision. Let me see. This is provision. That is salary payable, payee payable, electricity payable, on earned commission and fee income. On earned commission and fee income, they also created a provisions for it. So what does it mean? It means that this stuff, they've paid for it, right? Because they paid for it. Now, if normally in your in your in your profit and loss account, you discover that once you have an income is always going to be credited. So you see that income is already credited, right? So in order for you not to over declare that income, right? So just go and create like an expense for it. So when you now say, okay, they paid us 50 million, 16 million out of it has not been earned. So just go and create it like a provision. So what you are doing is that you are creating an expense. So it's like the credit amount, you want to reduce it by debit amount so that only the amount you want to now let to be in your account will now be the only amount that you actually earned. So a provisions will actually create for unearned commission and fee income. So that is how it is. Then a provisions can also be created for IT, whatever, and all that. Then we also have trade payable, right? Trade payable. So these ones are not provisions. These are trade payable. We know that, okay, once you are in a business, you're going to have liabilities, trade payable. We also have other payable. We have other payable and all that, other payable. So all these are going to be reflecting under your balance sheet. Then we also have dividend payable, which is also going to be other payable. Then we have withholding tax payable, right? All that. Then for here we have underwriters, co-brokers, control account. So like that. Then we have employees pension payable. We call it employees benefits. So that is how we're able to do all that. So we have been able to take care of all our what's it called? Our um equity and our payable. Then we now come over to where we have all our assets, right? So we call them PPE. You can see that all these are PPE, 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 and so on, PPE. Then under taxes now, our taxes, what's our taxes going to be? So we have, we have accumulated depreciation and all that. Then our deferred tax asset, our deferred tax asset is also is also an asset to us. It's not a liability. So we have our deferred tax asset. We have our investment. We have trade receivable. It's also an asset to us, which is current asset. We also have it. Then we have prepaid rent. It's also an asset to us. We have, so all these things are just showing us. Then we have our banks. Our banks, all these are cash and cash equivalent. All the banks are cash and cash equivalent. So let's now go and see what they did with this information. So let's come to the right-hand side. Let me go to the top, to the right-hand side. You now see that to the right-hand side here, they are now creating. So look at the right-hand side now. When I say that, okay, unaudited, it's not audited yet. 6 months. This is for 6 months because I told us that we are doing biannual. The first one is the first 6 months. So we now say, okay, basically we know the way our statement of financial position usually is. Your asset will be up, your liabilities, and all that, right? So let's now see what they did. The first one is we are talking about our assets. The first one we're talking about cash and cash equivalent. You know what is going to make up your cash and cash equivalent? Those are your banks. So we check here now, you're going to see your banks are what we call our cash and cash equivalent. So let me go and check what they capture. That is AA140. AA140. So let me just go and check. So this AA140, this is what they capture under your cash and cash equivalent. And it's a summation of V63 to V74. So I will just press Control open bracket. Look at it. So look at what they capture. Exactly, your cash and cash equivalents. Look at what they capture. All the banks, all the balances at the bank, petty cash, and all those. So those are your cash and cash equivalent. So this is what we put over here as your cash and cash equivalent. And it's also what you can see under note 1. Okay, if you go to note 1, you're also going to see where they arrange it together in your note 1. Then the next one we're talking about is prepayment and other receivable. Prepayment, all these are assets. So under a prepayment and another receivable, you can see what they did. So let's go and check. Yeah, prepayment and other receivable. Look at what they added. Look at what they added. Prepayment and other receivable. So we're having yeah, so what we prepaid in advance, we have in other receivable, we have other receivable, all these are receivables, they are all assets to us. Yeah, all the receivable, okay? So things we paid in advance, prepayment, and other receivables. So that's how we're able to get that. Okay, so prepayment and other receivable. Then the next thing we're looking at is property, plant, and equipment. Definitely you know how to get your property, plant, and equipment, which is going to be, you're going to take all the assets, then you also now less your accumulated depreciation. So let's come and check. So you're taking all the assets, and then you are lessing away all the accumulated. So look at this asset now. All these assets were added together, then we took away all the accumulated depreciation on the asset. I'm sure that majority of us, we know how to do depreciation now. This is not going to be an issue for us. You know how to have the asset at cost. They also know how to have the accumulated depreciation that the asset has actually suffered, okay? So that's how we're going to have it. So the asset at cost minus the accumulated depreciation, so that we're going to have the net amount is what we're going to have, the net amount. And that's how we're able to get this 16 million. Okay, now the next thing is deferred tax asset. I wonder why there's no deferred tax asset here. Deferred tax asset. Oh, there's no figure for it. Okay, there's no figure, no information for that. You know how to get your deferred tax asset. You also know how to get your deferred tax liability. Does anybody know on the call? You know how to get your deferred tax asset and your deferred tax liability? Hello, can you hear me?
Just to try.
Okay.
Okay, so first, deferred tax, either asset or liability, is the difference between the carrying amount and the tax written down value, whichever is higher. For instance, if the carrying amount, if the carrying amount is higher than the tax written down value, then there will be tax deferred tax liability. But if the tax written down value is higher than the depreciation, that is the carrying amount, it means there will be deferred tax assets. And will come up if, as a result of the difference between the depreciation, the use of depreciation and the capital allowance on the same assets. I don't know if my explanation is clear enough. Thank you, sir.
Okay, so thank you very much. Does anybody also want to try? Is anybody also going to try? Let's see if somebody else wants to try. Any other person? Okay, so if you're looking at deferred tax asset and deferred tax liability, first of all, you must have done what we call IAS 12, right? Income taxes. So under IAS 12, you discover that you are going to be having what we call accounting profit, as well you're going to have the tax profit, right? So usually you are going to be comparing the carrying amount of an asset. To get the carrying amount of an asset, you're checking the cost of the asset. You're going to take away all accumulated depreciation or all accumulated impairment losses. Then you're also comparing that carrying amount, you're comparing it to the tax base of that asset. What is the tax base of an asset? The tax base of an asset is that value that is allocated to an asset or a liability for the purpose of tax. Okay. So now it means that to get that tax base of an asset, you are taking the cost of that asset, you take away the carrying amount, you deduct the carrying amount. What you're going to have is what you're going to call the tax base. Now, remember, you are comparing the carrying amount of an asset with the tax base of an asset. Now, I will now explain to you what makes it a deferred tax asset or what makes it a deferred tax liability. You will discover that when you if your carrying amount, right? They say if your carrying amount is higher than your tax base, they say that you are going to have a taxable temporary difference. You're going to have a taxable temporary difference. However, if your tax base is higher than your carrying amount, you're going to have a deductible temporary difference. So whatever temporary difference you have, just multiply it by the tax rate in the question. So what makes it an asset? What makes it a liability? The first one, if you have carrying amount and your carrying amount is higher than your tax base, what does it mean? It means that that carrying amount, right? When you are charging it, for instance, let's assume you have an asset that has a carrying amount of 50,000. Then we have another the same asset. It has a tax base of 20,000. What is the implication? And this asset still has like 5 years to go. Okay, so the asset, right? It has a carrying amount of 50,000, and that same asset has a tax base of 50,000. What does it mean? It means that when you take the cost of that asset, you minus all the accumulated depreciation and accumulated impairment losses, you are going to have a carrying amount of 50,000. When you also take that asset, take the cost of that asset minus the capital allowance, you're going to have 20,000. And remember, this asset still has 5 years to go. So it means that this 50,000 that is remaining, you're going to divide it by 5 to show that for each year, you're going to be charging 10,000 in the account. Why the other one is having a tax base of 20,000. If you divide 20,000 by 10, I think you are going to have, sorry, you divide 20,000 by 5. Is that not 2,000 or 4,000? Is it 4,000? 5 times 4, 20. So 5 years. Yes, that's going to be 4,000. So you discover that when you are charging when you are charging 10,000 as expense, as depreciation in your account, the other person, the taxman is saying no, you are not supposed to charge 10,000 as expense or as depreciation. Rather, you're supposed to charge only 4,000. So what does it mean? It means that it's going to disallow certain expenses that, so it's going to disallow depreciation. You remember, they usually disallow depreciation. You've already charged depreciation of 10,000 in your account. Then the tax one will disallow 10,000. And in place of 10,000, it will say take 4,000 capital allowance. So you discover that the profit you are going to pay tax on is going to be higher when you are looking at your 4,000. When they disallow 10,000, they allow 4,000, meaning that you're going to pay more tax on that stuff. So you have been taking, because you are going to have your own accounting profit. Your accounting profit has been very little based on the big capital allowance that you are charging in your account. You assume that your capital allowance is 50,000 that is remaining, and you divide your capital allowance by 5 to get 10,000 per each of the years. Now you discover that in each of those years, you're going to be charging an expense, a depreciation of 10,000, whereas the taxman will come and disallow it and say, no, you're not supposed to charge up to 10,000. He will give you, in place of that, give you a capital allowance of 4,000, meaning it will tell you that you need to pay more tax. So that is why if your capital allowance is higher than your tax base, it's only going to create a taxable temporary difference. And a taxable temporary difference, when you multiply by the tax rate, is going to create a deferred tax liability. But when you have a deductible temporary difference, you multiply by the tax rate, it's going to create a taxable, a deferred tax, a deferred tax asset. Am I confusing us? Hope I'm not confusing us. Mother Miracle and the other lady, hope I'm not confusing us by this deferred tax asset, deferred tax liability, and so on and so forth. Anyways, if you want more on this, that is IAS 12, okay? That's the information that relates to IAS 12. But yeah, so that's IAS 12 actually. So that is IAS 12. So that is what deferred tax assets and deferred tax liability is about. So because this is an asset, we're under asset, we're going to put it over here as the asset, okay? So, and over here, there's nothing like that asset here. So therefore, we just put here, we pick here. And as I told us, everything is linked, right? Everything is actually linked. So that's why you're going to have this thing on. So your financial asset now, what is your financial asset? Let's check for them. Your financial assets. The financial asset is talking about the stocks that you invested in, okay? Just like your investment, like, okay, investment in treasury bills, investment in stock and shares and all those stuff. So those are your financial assets. So that is how we're able to get this, our profit and loss account, okay? Sorry, I mean our financial. So we've done that. We've done with our asset. Now, the next one I want to talk about is our liability. So under your liability now, you're going to have employee obligation, employee benefit obligation. So let's see what they picked. They actually pick employee pension payable. So that's why we have employee benefit obligation, right? So that's how we pick that. Then the next thing is we are looking at current tax liability. Current tax, current tax liability. Now you know what current tax is. So let's see where they pick. Let's come and check. Yeah. So current tax is actually in the question. Current tax. Let's check. Yeah. So current tax, that is the actual tax that you ought to pay. So is the movement between your deferred tax and yeah, and your current tax. So the movement, that is what you're going to have as the current tax liability. So that is how they were able to get that. If you need more clarification on all these taxes, then you might need to check IS 12. IS 12 talks about all these taxes, right? So that's how we're able to get our current tax liability. Then we now talk about our deferred commission income. So now this our liability. You already know that we also created a provisions for our income. We put a commission, sorry, we created a provisions for our income. Okay, in order that any income that we've not earned, we don't want to capture it as as the sales for the period. We don't want to capture it. So we want to capture it that okay, we are owing these people. Normally what we do is that whenever somebody pays, we credit sales, we debit either bank or cash, or if the person has not paid us, we debit the vendor. Sorry, we debit the debtor account. However, because the person has paid and we are yet to earn it, so instead of us to debit, sorry, instead of us to credit our sales, we're supposed to credit only that portion of the income that have been earned to sales, and the other portion we credit it to our deferred unearned income. Okay, deferred commission income, we credit it. Okay, that's what they did over here by creating a provision. Remember, they created a provision for this to create an expense in the profit and loss account, which that expense is going to go and reduce that income in the profit and loss account. So that they will not carry this as a liability in the balance in the financial statement. Okay, so that's how we're able to get this our deferred tax. Sorry, this is our deferred commission income. That's how we're able to get it. Then we now get provisions and other payables. You know how to get your provisions and other payable. Let's quickly go and check provisions and other payables. So all these places where we have provisions, where we have other payable, this is where we pick all of them. Okay, that's how we picked all of them. So when I come back, and that's how we were able to get it. Then deposit for shares, this is not here, nothing is here. Then we have our deferred tax liability. Deferred tax liability was gotten from somewhere. Yeah, so deferred tax liability is actually there. Okay, so that's deferred tax liability. Then, yeah, so that's our deferred tax liability. And yeah, so that's how we got our deferred tax liability. Then it became our total liability, right? When we add everything, then the next thing we want to have is our equity. Our equity now, we have our share capital. You know where our share capital is going to be. We have our retained earnings. We have our fair value reserve, which is also there. We have our total equity. So we now have our total equity, which is going to become this plus this minus this. And that's how we got our total equity. So at the end of the day, we now have our total liabilities and equity to be this amount. So when you compare it to what you have, your assets and your total liability, equity and liability should actually give you the same amount. At the end of the day, if it's not correct, you're going to see the difference that you have where. And the difference that we have was as a result of what I changed at the beginning. Remember, I changed this one from 5 million. Then I also change what is here also. I also change what is here also at the beginning. So let me go and show us. So I change what is here. I also change what is here as well, which is making, which is, I change what is here as well, which is making this thing not to be correct. Okay. So that is that. Now let's now go back to what we are doing. So these are we able to do. So this extended trial balance, this is how to do extended trial balance, nothing difficult. Then the next thing we are looking at is we are looking at the profit and loss and other comprehensive income. Under our profit and loss and other comprehensive income, we're actually looking at the yellow part. I told us that this yellow part is where we are going to use for our profit and loss and other comprehensive income. So exactly what we did the other time, where we had revised, sorry, where we had revised, yeah, so revised balance. The same thing we did the other time is what we're going to do. When you come to where the yellow place is, we're going to do now. Let's now come to where the yellow place is. So the same thing we did the other time is what we're going to do. We're going to pick where the value is this minus this plus 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 this minus this. Okay, so when we get to the end, to this place, everything is going to report here. So that is how we're able to do all of them, right? So all these are the incomes that we have. Anything on the credit side, we are going to do the same thing. Then for the debit side, we also do, so let's check. So we're going to say, let me go to that place again. Yeah, so for this one now, I'll say that for this one, I'll say this, right, plus this. So you're going to say this plus this minus this plus this minus this. So debit with debit. So it means that here, this is where we are starting. Let me just put a mark there so that you understand what we are doing. Okay, so now look at it now. So this is the actual, this is the actual trial balance that we imported. We imported this trial balance, right? So if you want to now start, if you want to do our plus and minus, let's come back to where our income is. So where our income is, so we've done for income, which is going to be our credit side, our credit plus debit plus credit plus debit plus credit, like that. Then when we now come to expense, that is for income. For expense, we're also going to pick here this, which is a debit. Now, don't forget that this is what we are adding. We are adding everything from here, from after this line. So we're going to pick this plus this debit, right? Because this is debit and this debit also. So this plus debit plus debit minus credit plus debit minus credit plus debit. So that's how we're going to do everything. And that's how we're able to get our revised balance over here. So we're able to get our revised balance over here. Then this revised balance that we've gotten is what we're going to use for our profit and loss. You can see that immediately is going straight into our profit and loss. So this is it. Everything that we have over there is what we are also putting under our profit and loss, exactly the way it is over there. That's what we put under our profit and loss. Then the next thing we want to do is we want to now go straight to that. Let's now go straight to that place where we have our statement of what is it called? Yeah, so I want to come to, let me go to the top. Yeah, so this is actually easy. This one is just going to become your income. Then you also have all your expenses. So here, we now talk about our income, which is our commission and fee income. At the heading is profit and loss and other comprehensive income for the year so and so. So you're going to have your commission and fee income, which is an income to us. Then other operating income will also be added. Then when you've gotten all those things, then you want to have your direct commission expense, just like you normally have your cost of sales. So direct commission expense, you want to have it, right? So when you take this minus this, you are going to have your gross profit, which we are calling operating profit over here. You can call it whatever you want to call it. Either you want to call it gross profit. That's up to you. So you're going to have all the incomes here, then other operating incomes. In case there are other operating incomes, you put them here, you add them together. Then you want to have your direct commission expense, which is like your cost of sales. You want to have it here. So we now say that, okay, your operating profit is now going to become this plus this minus your direct operating expense is going to give you your operating profit. After that, we now talk about other income, investment income that you have, you had it, right? You now talk about investment expenses. If you have it, you need to less it, right? Then other income you also need to add. The management expense, you are going to less. Impairment loss, you're going to less. Finance costs, you know what finance costs are, you're going to less it. Then at the end of the day, you want to determine, so this is a loss that was brought forward. You also want to put it, then income tax expense that you need to pay, you put it here. At the end of the day, when you do your plus and minus, you're going to get this figure. Then underneath it, that's when you now do your other comprehensive income. So other comprehensive income, like other comprehensive income, you are having this value as your other comprehensive income, right? So let's go and check what that other comprehensive income is. So that is a fair value loss on quoted equity. So that is other comprehensive income. It could be a profit, at the same time it could be a loss. So over here now is a loss. Other comprehensive income is a loss here. Then total comprehensive income for the year is going to be this minus this, which is going to be this, right? Then you now have earnings per share, and all those stuff. So this is how to do your extended, what's it called? This is how to do your extended trial balance. Okay. So I'm coming, let me check for something. So here I have AA53, this divided by AA27. AA27, let me see. AA27. Yeah, AA27. Okay, that is share capital. Okay. Remember the share capital. So that is our other comprehensive income. Our other comprehensive income divided by the share capital times 100. So that's how they were able to get these their basic earnings per share. Okay, diluted earnings per share, the same thing. So any question? Do you have any question? Everybody, do we have any question? Do you need any clarification? Is there something that is not so straight to you that you need clarity on? Hello, Bisa Chukwu Emeka Eze Ali. Okay, so basically, we are looking at the extended. So we are looking at what we are doing is that we are trying to look at how this account was actually created. If you have these templates that I'm going to give us, I'm going to share to us, it makes it easy for us. I've been trying to make sure that we all understand how to get our trial balance, right? Which is this trial balance that we've gotten. So once you're able to get this trial balance, from this trial balance, you can easily link it. I'm sure I've shown us a trial balance which we were able to get from either our postings. Either you want to post something to get your trial balance, or you want to use bank statement. I also showed us how to use bank statement to also get your trial balance. So once you've been able to get your trial balance like this, remember the arrangement. Everything that is here, you're not going to tamper with anything, right? You're going to leave it and put it exactly the way it is, because the template we're going to use is also designed in such a way that we're going to have our items of profit and loss underneath. Then our items of balance sheet will be at the top. And then from here, we are going to link this one to this other template that you have. And this other template that you have is designed in such a manner that it's like the extended trial balance. So once you put it, then any other changes that is happening to each of these items, probably your share capital, maybe somebody now decided to, one of the directors decided to put more money in the company, right? For instance, one of the ways in which your share capital can increase is that normally maybe there's an expense that you are supposed to that is due for payment. However, instead of the director to tell you that okay, let's pay it from Susu Bank, the director decided to transfer to pay that expense from his direct account, right? So it means that that director actually paid. So instead of you to debit, instead of you to credit the bank or your cash, you can decide to credit that director's account. Okay, to discover that that director might be probably he paid that money through Zenith Bank or something, or maybe the person also gave the company additional money. So if the person gave the company additional money, he paid it into the company's Zenith Bank account. You come here and put the amount, because at the end of the day, you're going to have a revised balance at the end over here, which we got it as a result of plus minus, and all that. So what you need to do is that you need to lay your hand on this template. You need to go through it very well, because this template has been linked. Everything that you have here has been linked. All you need to do is that understand this thing well. If you understand this thing well, you can easily fine-tune this thing to your own taste and check where it is linking. So this is for the first 6 months. The other one is also for the second 6 months. Almost the same thing, right? It's almost the same thing, right? So almost the same thing. Yeah, so it's almost the same thing. Now, who can tell me, how does our retained earning, how does it increase? Over here, we have retained earning over here. Let me see our retained earning. Okay, so yeah, we don't even have, okay, I was the one that took away the retained earning that was here. So let's even assume that we don't have any retained earnings over here. What makes our retained earning to increase to this value? Who can tell me? What usually increases the retained earning of a company?
Good evening, sir.
Yeah, good evening. I can hear you, sir.
Yeah, let me try. Yeah, what normally increases the retained earning of the company is their profit, net profit, part of it that has not been distributed as dividend. Their retention rate determines how the retained earning will increase over time. Yeah.
Okay. Thank you, sir, for that wonderful one.
Thank you, sir. Thank you.
Yeah. So that's basically it, right? So that's basically it. But I think companies, they don't, you won't see, they won't indicate, though they can declare dividend that they will pay, but they don't usually deduct it up this account now. This account over here, we checked for our statement of financial position. Then underneath, we also checked for statement of profit and loss and other comprehensive income. We discovered that over here, at the end of the day, they are having either they're having either a loss or profit. So whatever you have at the end here is what is usually had to the retained earnings, right? Even because here they will not show the dividend that they are going to deduct or anything. So that's what they normally had to the retained earnings. Anyway, let me not confuse us in case we know it the other way, but it's fine. So I just wanted us to know that. So with this, I think we are good to go. From here now, we will be able to understand what is actually happening and how they are actually getting all these things. They are not difficult. So from here, all these things are linked to this. They are linked to this final extended trial balance. So it's in this final extended trial balance that we have the item in the first extended trial balance and the second extended trial balance merged together. So it now came over here into this other extended trial balance. Okay. I think in a way is linked, right? So it's linked. You can see that it's linked. So naturally on its own, it's actually linked. So that is how it's going to be. So I think this should be linked to the second. Let me check. It should be linked to the second. This is what I want to say. So it should be linked to this one. So automatically, when you are one is own, they are going to be operating on their own. So this is where you now have the combination together. So this is where you have them together. Okay. So this is where you have them together. Going to be populating on its own. Then after that, this also goes to other accounts, value added service, value added, whatever statement, sorry, value added statement, all of them are linked, right? All you need to do is just populate the extended trial balance that I showed us, just populate all these things are linked. Then you also come over to, it will even surprise you that most of the notes, these notes also, they are also, okay, some of them are not linked. So some of them you might need to like manually know what needs to be done, right? But some of them are actually linked, right? Some of them are actually linked. So that is for that. Then the most important aspect now is the main financial position, which is this. This is the main one that we're going to use. So these are linked already. They are all linked to the extended trial balance. They are linked. Then this is going to be for the previous years, which you don't need to bother yourself about, and all that. So that is how we were able to get all those stuff. So let me check for something. Control this. Yeah. Okay. Let me check again. Profit and loss. C34. 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 Period. For a period. Okay. On that note, I think so the provision for the okay, okay, I get it. So those okay is what is now actually now you actually now carry over and added to their earnings. Okay, we give them retain any for the next. So you're actually correct, sir. So on that note, this is how these are. So each of these are linked. I'll share all this file so that we can actually have this file so that we can also learn with it. So with that, I think we have come to the end of today's class. All you need to do is get this material and start to run with it. If there's anything, any clarification you need, anything, any addition, any subtraction, you can always reach out to me. I'll be glad to provide answers to us. But one thing is that you need to see the file, you need to interact with it for you to be able to understand what is actually going on in this template. So you can see that this our training is actually full of a lot that you're going to learn. At the end of this training, I believe that we shouldn't be before the training. Today, any question? Do we have any question before we call it tonight? Hello.
Yeah, none from my end, sir. Thank you.
All right. So, Glory Edit, Ibrahim Shitu,
Good evening,
Olutayo.
sir.
I don't have any.
Good evening.
I don't
No
have
question.
Okay.
I'll be
So
practicing
I
with
guess,
the templates. Yes.
We'll be
okay, no
expecting
problem.
that.
Yes, I said I'll
The
be
last
practicing with you. Thank you.
Yeah, so for the last week, I have actually sent us, if you don't, you will see, I will also tell you, so for it,
I think the network is bad. I hear better.
okay, so I will share this with us so that we can actually have this, that is, yeah, so I'll share this with us. So you go through them, and then when you have any question, you can always reach out to me, and I will be glad to actually provide answers to us. So on that note, thank you everybody for your time. We continue after the Easter break. So we will not meet tomorrow because tomorrow is Easter. So let's all enjoy the celebration. Thank you, everybody.
Okay, thank you. For regard to your family.
Good night. Happy Easter in
here, sir.
advance. Yeah.
Thank you,
Thank
sir.
you,
Good night.
sir.
Good
Yes,
night.
sir.